Good morning, everybody. This is John Locke, and welcome to the Locke Your Success Trade and Market Update for February 10th, 2014. Before we get going, we'd just like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, any results and/or trades in the presentation may or may not be live trades. In the event anything's computer simulated, we do the best we can to make sure that it is as accurately represented as possible. And also the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And come on over and visit our website if you watch this on YouTube and check out our programs. Join our mailing list, get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for this free weekly webinar. And of course, the M21, the time is now. I have, just as a note, next week there will be no trade update webinar. What I'll do is I'll record one on probably Friday night or Saturday and go ahead and post it because I'm going to be traveling to New York City to teach the M21 workshop. This is going to be the most comprehensive, positive data trading system program that's on the market anywhere. It's going to be a lot of fun. If you now want to go, I really encourage you to do so. It's going to be a lot of fun there. Also, I'm going to be on Options Tribe on Tuesday, and we're just going to kind of give a preview about what the program is. It takes a while to explain. It's what I got. I have probably 8 or 9 hours of content there teaching it. So it's a lot to do with technical analysis. We do a whole section on that, on how to use technical analysis as an income trader, and I teach you how I analyze the market and so forth, and then try to show you how to design a trade around it. And we also deal with trading psychology and proper execution and timing adjustments, all kinds of neat stuff. So that should be fun. All right, and I'll post a link to register for that too if anybody's interested. So let's move on and take a look at the market. One of the things we were saying last week when we look at the Russell here is that we were kind of at a decision point whether the Russell was going to drop out or not. The chart at the time looked bullish, but I also said that even though the charts did look bullish, I was expecting a move down in the Russell to around 1100 to 1075, and that was because of this support area here. And the Russell did just that. I did not expect it on Monday. I expected more of a gradual move, something like this here where we have that move covers 3 or 4 days. It happened in 1 day, so that was a pretty aggressive move. Sent a lot of us scattering on Monday a little bit, but it's completely expected. And then, we hit our support level, we had a bounce. That's pretty much normal. Question is, where do we go from here? The interesting thing that I'm looking at is if you look on the weekly charts and we look at the SPX, for example, and we use a weekly bar, we penetrated our yearly trend channel that we've had here, and we bounced right up past, right back into it. That is considered to be extremely bullish action. And the same thing basically on the NDX. All we did here is we came down, we slightly penetrated. If you remember, the NDX had a yearly channel, and then it has a more aggressive channel. We came down, we penetrated the resistance of the yearly channel as well as the support of our daily channel here. And this, again, looks extremely bullish. And the Dow coming down to its weekly trend line and holding that trend line is also looks extremely bullish. So I have 3 indices that look pretty bullish. I have the Russell that looks bearish. So we have a little bit of divergence in the indices. I'm still looking at, let's see, I'm still looking at the Russell expiring up here around 1130. That would be my best guess. And I still think we're going into a sideways range, but it's going to be a relatively wide sideways range here from 1075 to around 1175, so about a 100-point sideways range. And that's not terribly unusual, but it's about twice the range we had. So basically for the markets, I'm thinking the Russell continues sideways. The SPX and the Dow and possibly the NASDAQ could make new highs. If we'll have to watch if they turn around and they break down, then things could get ugly here in the Russell too, because we very well may break this support level. So that's what we're thinking for the markets. As far as the trades, The move on Monday took out, well, it didn't really take out the March V condor. I chose to close the March V condor after that move. With this move down here, I would have had to buy back more of these short strikes, and that being the case, I would have to really have very little chance of this thing making any money. I just decided to close it down and get out of the market. This has been a very, very good trade for the last year and a half or so. I don't think we've had a loss in it for a year. I know we have it in at least a year. I don't think it's been even a year and a half. So this is very good. And the good part about this type of a trade is usually when you take a loss, it's only like 2,700, which is less than what we usually make on it. So very happy with the trade. This was just a victim of poor timing. That's all it was. We put it when we were very high on the market. We had a very aggressive down move, and we had to get knocked out of it. So it's that's fine. That happens sometimes. As far as the bearish butterfly, that had no adjustments last week. It took this down move with ease. It was no problem whatsoever. If we come back and take a look, this is up $2,800, and we've had no adjustments. That's what we look like as of Friday afternoon. And if the market does what we think it's going to do and it holds this 1130, 1135 area and it comes back down in the range, this will be pretty nice this month. And let's see, the next trade here, we'll take a look at our February V condor, which got one minor adjustment, and that's buying back a put. And I can tell you that it's very, very rare to have to buy back calls on a V condor and then have to come back and buy back puts. This is the position today. Let's go back to the position on Monday. So I bought back two of these calls when the market went up. We had the harsh reversal here, and I ended up buying back two of these calls to keep my delta where I wanted, puts to keep the delta where I wanted it. And as of Monday, the position looked like this. Not in terrible shape. It's handled the move quite well. And the volatility is getting to us a little bit, which is why it drew down a little bit of money. When the market reversed, I ended up selling those puts back off on, I think this was Thursday. I sold one off, and I sold one off on Friday. So just to, we still had a lot of value in them, and by selling them off, I neutralized my delta and kept it neutral. So here's what we looked like as of Friday. Come in here, and the position is back up again, about $300, so we're pretty much break even. And as of today, we look like this, and I'm very happy with this. I probably won't pull 3,000 this month, but it's a possibility we do. We'll see where the market goes. Let's see here. We also have two other trades on. We closed the bearish butterfly a couple weeks ago at a decent profit for the month. The February rock trade. Let's take a look at that. That took a bit of a beating with the move down on Monday. So I'll show you the move. I'll show you the position as we came into the day. Let me switch to the rock trade. So coming into Monday, we're down 8 points. I don't know if I did anything as of yet. Nope. So I'm watching this intraday, and around 11 o'clock, we hit our maximum delta, and we roll these 1120s back to 1100 completely by guidelines. So if we're looking at this, we're basically in, we're in an M3. Yeah, we're in M3R position right now. And the M3R position is pretty resilient to price moves. And when we talk about the M21 system, sometimes we'll even start a trade out this way if we're expecting a lot of price movement in the market and we're thinking the market might end up here somewhere. And this is, this got rolled back. So by the end of the day, we look something like this. And we roll back to the 1100s. We're about positive 47 delta, which is right around the maximum delta we like to see. I decided not to touch this on Wednesday. We got down, I think intraday it exceeded the delta, but not by a lot. If we come back up to Wednesday, let's see what that looked like. If you see the end of the day, we actually had 59 delta, which is fine. We were allowing a positive 100. Intraday, it did, I think we were down 10 or 15 points intraday, and it may have tagged 100 delta. I'm not sure if it did or not, but it was just barely. That being the case, I did not roll this back. So Wednesday, this looked kind of like this. Even though we're past our short strikes, our delta numbers were really good. And I'm looking at the charts. I'm saying, well, we're going to turn around here at 1075 anyway. So just kind of left it alone. And on Friday, well, I think it was Thursday, I had to put some verticals in here. So if you come up here, yeah, on the 7th, okay, because it was after 5:30. On the 7th here, I put in some 1100, 1110 verticals to bring my delta down under 100. And the position's doing okay for being whipped around like it was. This was I remember when I put it on, I was saying I didn't like the entry because I thought the market was going to drop a lot, and this isn't the best position to be in if the market's going to drop a lot. But the rock trade usually, if you drop back into roll back rock and then to an M3R, it usually handles some pretty tough moves. So this is still doing okay. And let's take a look at our M3 for February. And I did make some moves on that as well. So let's go back to Monday. We were here, market's down $8. I did do a rare intraday adjustment on this because the market was so vigorous, and I happened to be home because we were just finishing up the trade update, and I was getting it posted to the website. So right around 11 o'clock, we took these and we rolled them back to this level here, which was 1120? No, I'm sorry. We rolled them back to 1100. So the way I usually do this when the market's coming down at me is I will buy the 1100s to straighten my delta and get that down. And then once I buy the 1100s, a lot of times I'll let this sit for a little while in the rest of the day, and that's what I did here. In the morning I came in, I bought the 1100s to straighten out a delta prop, but I didn't sell the other ones off for a half hour later. So I came in here and basically, if you go to 11 o'clock, actually that was both between 11 and 11:30, so you're just going to see the roll. But I bought these, and I eventually sold these off. And towards the end of the day, we looked kind of like this. So with the volatility, we did get a bit of a drawdown, but nothing terrible. And on this position here, I know I bought verticals on Thursday. Yeah, okay. So when the market reversed hard Thursday afternoon, we came in here, did 1100, 1110 verticals. And by the end of the day, I guess that was Friday too, wasn't it? Anyway, by the end of the day, oh, I'm sorry, I'm showing you the rock trade. Thank you for telling me. That's why I'm having the problem. I said, this looks just like the other trade. All right. All right, so here we are, beginning of the day. Here's what we look like, and I apologize for that, everybody. Right, okay, so I came back. I did the same thing with the rock trade, right? When I rolled back, I added one, and then I did a little bit later. This one here, the same thing. We added a butterfly at a little bit lower, at 1100. Sat in it for a while, sold out at 12 o'clock, and then we did these verticals in here. I did 10 of them instead of 5, so that was pretty good. Let's just pull this forward. We'll show you where we ended up on Friday. And this is where we are as of Friday. We're up about $900. I closed Friday a little bit too negative delta. And I have terrible gamma trend, but I'm in the middle of the position, so I'm okay with that for now. If we get an up move today, this is going to be fairly aggressively vertical, put verticals into the upside to keep this, to get this T+0 line straightened out. But for now, considering the market moves, I am perfectly fine with where we are. So, and that is the actual M3 trade, not the rock trade that's pretending to be an M3 trade. And that is all the positions that we have on. So we're doing okay. We took that loss, minor loss in the March V Condor, but so far the rest of the positions have survived, and it looks like we're doing good. Now, did anybody have any questions with anything, or are we good? We got on my V trade, what's the reason for purchasing the strangle with such a wide spread? Why not leave the condor and just adjust either end if a with a butterfly if needed? Thanks. Okay, so this is just, it sounds like, Ray, you're just kind of talking about, why am I buying this strangle or straddle? Why don't I just start as a condor and adjust at either end? Well, I mean, you can certainly do that. That's not, like I said, there's a ton of ways to manage a condor. You can do a wide condor. You can adjust it when, and I have a lot of students who do this too. They'll just do the condor, especially if they think the market's going to be flat, because putting that straddle in there really eats up theta. It eats up, if you have it hurts the negative volatility advantage that a condor generally has. So if the market's relatively flat, you're definitely better off without a V in there. What the V does, though, is it gives you a lot more range and it helps with the volatility. So if you put a V condor on and you get a big move right away, it really helps against drawdowns. And also if you have a creeping market to the upside, a lot of times a regular condor will lose, and a lot of times you can't get the adjustment on in time in order to save it. In other words, it draws down too much. One thing about a wide condor is they don't make very much money, and you don't want them to draw down too much. So, and once you do that, they're kind of dead. So that's the reason we put it on there, is just for price movement protection. It's meant to be, a lot of people who trade a V condor is people who don't like to watch the market, because it's a relatively low yield strategy. So if someone's in retirement and they want to go on vacation, they don't want to watch the market a whole lot. They want something that's relatively safe, doesn't draw down a lot, and makes money fairly consistently, then doing it that way is very nice. If you want to be more active managing it, there are better things that you can do to improve your returns. It's a little bit more risky, though, like anything else. All right, is there anything I can do to improve the February V condor expiration line? Yes, there is, but I normally wouldn't do it until I'm far enough from my short strike where I'm not concerned about it. So February V condor, if I'm sitting here, we are getting close to expiration. And actually, you know what? Now that you say that, well, so anyway, what we do to improve it is we just take out the straddle. So obviously this will improve it a lot. And that's going to bring us up to about a $2,600, $2,700 profit. There are other things you can do. The call side's pretty useless. You could call it down. You could roll it down. I don't like to do that. And I mean, you could even close this if you wanted to. I actually have another V trade on where I have closed. I've closed the call side, something like this. That one's actually up a couple $1,000, so it was put on slightly different timing, and I adjusted it slightly different. But I just closed out the call side, and it looks something like this. And this expiration line is actually up 2,000. And if the market continues to creep down, it'll make a decent amount of money. I could do that here. That will obviously put me at a small loss if the market takes off. I'm thinking I like the position better with the straddle on it. So if I don't want to completely take out the straddle, what I could do is just widen it to a strangle, but that would not yield me a whole lot of money. So this is kind of destined, if I want to maintain safety, it's kind of destined to expire probably at around $2,000 profit. If I want to take on some price movement risk and risk the downside, I get rid of the straddle. I'll go a little bit negative delta, and that's probably the best I'm going to do with it. Okay, when you did verticals on M3, did you use put credits or call debits? I used put credits. And the video series, we use a lot of call debit spreads. At the time the video series was made, margining rules for Thinkorswim were that it was prohibitive if you weren't portfolio margined to use put spreads rather than call spreads. Because it would double your margin basically if you did a put spread, and if you did a call spread, it would only slightly increase your margin. So the video is mostly done with call spreads for that reason, and for one other reason too, is it's a little easier to identify what's going on if I'm showing you, teaching it with put butterflies with call spreads, because you can see both the adjustments. And some people have difficulty following if we're in that complex of a position on the put side. So I ended up doing it with puts and calls just so that they could understand better how to do that. But in reality, now that we don't have that margining issue anymore, if you're not portfolio margined, assuming you're in the U.S., you can do it with put spreads. You can do it with put spreads. If you are out of the country, some countries still have that margining issue, so you do it with call spreads. Oh, Gary, yeah. Yeah, so we have a question of what is gamma trend? And if we look at this February trade, generally gamma is a static number that doesn't really mean a whole lot, because whatever your total gamma number is, it's not that important, because gamma changes so fast every time that the price moves. So your gamma is either trending more negative as the price moves or trending more positive as the price moves. To keep the T+0 line flat, you could be very negative gamma here, but if your gamma trended or your gamma started to turn positive as the market moved up, then you would not have this sag, right? So the less important number is your actual gamma number. The more important number is how your gamma changes as the price moves on your T+0 line. And that's kind of what we're referring to. There's really not a number on the chart for it, but it's just the picture. And I mean, understanding this or keeping this so that your T+0 line is flat, you want to keep your gamma so it trends or it moves positive faster. And I could fix this position if I wanted to, but I choose not to. You cannot have a positive theta trade and have, let me word this properly, and have good gamma trend to both sides. So we're always going to have an issue to one side or the other. And we can control, I choose in this M3 system, I choose to control the upside. I choose to let the downside take on all the risk so that we don't have a risk to the upside. But basically that's what gamma trend is. It's the amount of change that the gamma has as the price moves to the upside or the downside. Okay. And let's see, I believe that's all we actually have for questions right now. So, and let's see, we're about 9:24, so it looks like we're all set. Let me just check my, all right, so that's nothing there. Okay, so it looks like we're all set. Thank you, everybody. I appreciate your attending. Remember, we have no meeting this month. I'll send out a video early, and you guys can watch that. And I hope to see you in New York City. If you can make it, please do. I'd love to see everybody. And I know a lot of people are coming already. And have a great week. Thank you, and bye.